welcome to Study Easy Made. I'm Priyanka and I'll be taking today's session on accounting principles. So, yes, accounting. What is accounting? In general definition, we can say it as a process of classifying, summarizing, communicating economic information about a person or a firm. What does this mean? Accounting is like keeping a record of money. How much money is coming in and how much is going out. Just like you keep a track of your pocket money or your salary and everything. Just to explain this in a very simple term, imagine you're getting 500 rupees from your parents and you want to spend 300 rupees on chocolates and then you want to sell it for a higher price. You're trying to put up a small shop, imagine, okay? So you're trying to sell the chocolates for 600. Now you try to record whatever happened, okay? You're just taking out a notebook and then writing it out. Money received is 500 and then money spent on chocolates is 300. The money earned via sales is 600. The money that you owe, you have right now is 800. So like that you try to write it down. This is called basic accounting, okay? So you're recording where the money came from, where it went and how much is left. So why is accounting important? Because it helps you know whether you're making a profit or a loss. It also tells you where your money is being spent. It helps you make better decision. So what it is? Accounting is generally language of money, okay? It helps people and business keep track of their income and expenses, okay? So why do you need accounting in general for companies? Because to actually check whether you're getting a good return on their investment or to assess the financial health of the company. Some directors and professionals use this to make comparisons between other companies, assess their strength and weakness, and decide what actions to take, whether to invest money in that particular company or not. Sometimes the creditors would want to know whether they'll be paid back well, okay, and also to check the liquidity. So and also sometimes government and regulatory agencies like registrar of companies and also you have other companies like from custom departments, IRDA, RBI, because they need information because for the payment of taxes, value added tax, income tax, customs, all that they need information, okay? So these are the basics about why what is accounting and why do people want accounting information. Okay, now we can see the types of accounting. Generally there are two types of accounting: financial and cost accounting. Management accounting again comes under cost accounting. We can see what financial accounting means. Imagine your school has a canteen, okay? Financial accounting is like a report card for the canteen. It shows how much money came in, how much money was spent, the expenses, whether the canteen made a profit or loss. This information is actually meant for outsiders because the school principal or the concerned authority in the school need to check whether the canteen is really doing well, right? So the information is for outsiders. The purpose of this branch of accounting is to keep a record of all financial transactions, be it the loss or the profit or the financial positions of a business, and disclose to the management and other interested parties, okay? So when it comes to cost accounting, here you are the here you can be the canteen manager, for example. Here the school runs a canteen and the information is given to the school. Here you are the canteen manager, which means this is for your own self, for internal use, okay? Because you want to know what is happening, how much cost it makes to make a noodles or a fried rice or samosa. How much does you are spending, like are you spending too much, are you spending less, or can we reduce the cost without reducing the quality? So cost accounting in general helps you check every detail of spending, okay, to save money and profits. It's mainly for internal use. So when it comes to financial accounting, it's for outsiders. For cost accounting, it is for internal use, the managers, the workers and everything, okay? It actually shows cost of each item or service, It is also more flexible. This is more flexible because you will have to decide it, right? But then if you see here, because the school will obviously question, so here they will be following strict laws, rules, okay? So what is management accounting? So the purpose of management accounting is to assist the management in taking rational policy decisions. It's like giving your manager a plan based on money and numbers so that they can make better decisions. So management accounting is generally for making decisions. It uses both financial accounting and cost accounting, but mostly it comes under cost accounting, okay? But instead of just recording, management accounting helps in making a better decision, so you can write it as decision making. So management accounting, okay? For example, you are the captain of a cricket team, okay? So you want to know information like, say, who is performing well, what is the strategy for the next game, where are we losing runs. Management accounting helps managers or other officials to make smart choices. Can we should we launch a new product, should we reduce the staff, or can we increase profits by changing supplies? It gives you a gist of information about all that, okay? So let's move on to the next topic. So yes, assets and liability. So what is an asset? Here it says companies' economic resources that can be defined in monetary terms. But like, what do you know about an asset? Asset is something like a business owns that has value. It can be money, it can be buildings, it can be computers, it can be a furniture, anything, okay? Um, what what are the current, you have two types of assets, okay? Assets include, one is non-current asset and current asset. Non-current and current asset, okay? Current assets are something that are things a business will use, sell, or turn into cash within 1 year. So the period is 1 year for both, okay? I mean, for current it is 1 year. So everyday things like, whatever the you have or the company has, that should be turned into cash within 1 year. That are current assets. For non-current assets are things a business will use for many years. Here it is 1 year for current. For non-current it is many years, and they doesn't sell it quickly. It will help the business over the long periods, okay? So the main difference is non-current and current assets. So non-current assets will include the fixed asset, non-current investment, the tax assets, long-term loan advances, or other non-current assets. For current assets, you will be having current investment, inventories, trade receivables, cash equivalents, all that comes under the current assets. The fixed asset, when I said fixed asset, it means tangible, intangible assets, the capital, all that, okay? So tangible is something that you can touch, feel, and they are physical items. You can see, touch, and feel them. Example, your school desk, bike, or mobile phone. Intangibles are things like you cannot touch. Example, I mean, they have value, but they don't have physical form. Your school's reputation, a song, or a brand name, everything comes under intangible. So in general, asset means a company's economic resources that can be defined in monetary terms. So they have two types. One is current assets and one is non-current assets. Current assets within 1 year, non-current is they will have it for many years. So these are the main difference, okay? Let's move on to the next topic. Next topic is liability. So what is a liability? Liabilities are obligations or debts that an enterprise has to pay at some time in the future. So in general, liability is something that a business owes to others, okay? Basically it can be a debt or an obligation that the business must pay back in the future. Simple words, the money the business has to give. If assets are what you own, liabilities are what you owe. Remember this. If assets are what you own. Liabilities are what you owe. Okay. Liability is like, say for example, you borrowed 100 rupees from your friend to buy some snacks. Okay, that 100 is your liability. You need to repay it back. Until you pay it back, it remains something you owe. We can see about the types of liabilities. Even liabilities have current liabilities and non-current liabilities. So current liabilities will include short-term borrowings, trade payables, other current liabilities that can be included. So non-current will be the long term, and then deferred tax liabilities, tax, other long term liabilities, long term provisions, and everything. Okay, so current liabilities are the things that the business need to pay within 1 year. Example, monthly mobile bill, and the things that you owe to the suppliers. Okay, so that should be paid within a year, like within a stipulated time. Like, so the you'll have to pay the salary to the employees within a period, right? So it's like that. For non current liabilities, these are the things the business will pay after 1 year, usually bigger loans or obligations, like for many years. Okay, it's like payable over several years, money borrowed from investors, or payments for rented assets, future payments to retired stuff, all that comes under liabilities. So you can write it as, for liabilities also you have non-current and current, right? So current is within a year, again just same like asset, and for non-current is pay later. I hope you understood this topic. Okay, so assets are the things that the business own. Liabilities are what the business owes: loans, creditors, bills payable, all that. So we have a golden rule that you'll have to remember. Okay, that is, increase in asset is debit. Okay, so decrease in asset is credit. For example, you buy furniture worth 1000 rupees for your office. Okay, so you're increasing your asset, so that would be debit. The same applies for liabilities. Increase in liability will be credit, so decrease in liability will be debit. Suppose you take a loan for 5 lakh, okay, from a bank. So loan is a liability, so you are increasing your liability, so loan, so the credit will be 5 lakh. Okay, I hope you understood the difference between credit and debit here. So you can write it as asset, liability, increase, debit, here credit, decrease, here credit, here debit. So total, why this matters, because for total debit will be equal to total credit, because always if you debit from one account, you must credit the other account, right? So you can have you can use a memory trick for this. So DR, direction of delivery, is debit. Okay, DR for debit and CR for claims, like liabilities and whatever you owe. So all that can be mentioned here. So next we'll move on to some of the basic terms. I hope you understood what is an asset and a liability, and the differences, and why are we using it, the main purposes. And also probably I can give you some more differences. So assets are something like the company owns or has the right to use. Liabilities, the individual or the business has to pay in the future. And there are two types: fixed assets and current assets. For assets, here they have current liabilities and non-current liabilities. Here when I said fixed assets, it is non-current assets. Okay, and also for example, for assets will be machines, the accounts receivable, land, everything. For liabilities, it is loans and more. Fixed assets are subject to depreciation, but liabilities are always non-depreciable. Assets is equal to liabilities plus the owner's equity. Okay, but for liability it is total assets minus owner's equity. Just remember this equation. Asset is equal to liabilities plus equities. So increase in asset, I said, this I think I mentioned. So remember this. This is something very important that you have to keep in mind. So assets results into flow of cash and increases cash balance, while liabilities results in outflow of cash. When you see a balance sheet, so I'm writing it here. So when you see a balance sheet, the right side of the balance sheet, they'll be mentioning the assets. For liabilities, it will be on the left hand side. Yes. So now we can see about some of the basic terms in accounting. So first let's start with the word entity. What does entity refer? Entity refers to a thing with a distinct individual existence. It can be a business entity or something, or some or individual existence, like, okay. So a business entity is uniquely identified business enterprise, for example, Adani or ITC or any other business entity that you can remember. Okay. So next would be transaction. A transaction is some kind of value that happens between two or more entities. It can be purchase of goods or receipt of money. A transaction means it involves two or more entities. Remember that. So next would be profit. What is a profit? So profit is like when a business earns more than it spends. Income minus the expense will always be the profit. For example, you sell a lemonade for 100 rupees, but your cost was 60 rupees. So the profit that you made was 40. Okay, so that is called a profit. So next is gain. Gain means a profit made from something other than the main business activity. Okay, so that is the main difference between profit and gain. Okay, so gain is like a profit that arises from events or transactions which are incidental to business, such as sale of fixed assets, winning a court case, appreciation in the value of an asset, or all that comes under gain. So what is a loss? When expenses are more than income, or the asset is sold for less than its value, it is called loss. Then what will go for expenditure? Expenditure means spending money to buy goods or services. It can be capital or revenue. So that is called known as an expenditure. Example, buying a chair for office use, that is a capital expenditure. Paying electricity bill, that is a revenue expenditure. Next would be discount. Discount is like a reduction in price given to buyers. There are two types of discount: trade discount and cash discount. So trade discount is given at the time of purchase or sale. It is not recorded in the books, just reduces the price directly. But then for cash discount, it is given for quick payment. It is recorded in the books. Okay, so these are the two types of discount. Next is a voucher. Voucher means a document that proves a transaction happened. Example, cash receipt, invoice, bill. All that comes under voucher. What are debtors? Debtors are accounts receivable. People or business who owe money to us. To owe money to us. We sold them goods on credit. Okay. Because, for example, you sell goods to Raj for 500 rupees. He'll pay it back later. So Raj is your debtor. Next is creditor. Creditor means people or businesses to whom we owe money. We bought goods on credit. For example, you bought goods from Ravi for 800 rupees to pay later. So Ravi will be your creditor. Next, revenue. Revenue is total income a business earns from its main operations. So revenue is not the same as profit because expenses must be deducted first to get the profit. So next, what is an expense? Expense denotes the cost the business pays to run daily activities. Okay, example, the rent, salaries, electricity, advertising, expenses are deducted from revenue to calculate profit. And also tangible and intangible, I've already mentioned. Tangible is like it has a physical presence that you can feel, touch, all that. Intangible, they have a value but they have no physical presence. So I think that's it for the basic terms. I hope you understood till now. In case if you don't understand anything, just pause the video, try to write down and note down where you have a doubt, and let me know in the comment section. I'll try to answer it. I'll definitely answer it. So now let's move on to the next concept. Next would be the basic accounting concepts. With this, our session will get over. So what are the basic accounting concepts? Business entity, money measurement, accounting period, cost, dual effect, dual aspect, revenue recognition, matching, full disclosure, consistency, conservatism, materiality, objectivity. This is very important. We have got several questions from this topic. So try to understand this topic in a better way. Okay. So yes, let's get going. First, what is a business entity concept? Here, they treat the business and the owner as two separate people. Even if you own a shop, your personal money and the shop's money are not the same. Here, you are treated as two different people in business entity. Money measurement concept is that only things that can be measured in money are recorded. For example, you can write bought a table for 1000 rupees, but not something very unrelated to other than money, okay, because whichever it cannot be measured, or something that you have some thought and you want to write it down, you cannot do that. Money measurement concept is that only things that can be measured in money can be recorded. And next would be going concern. Going concern is very important. Going concern is, we assume that the business will keep running in the future, unless and otherwise we are told that the business is going to shut down, or the stock of the company has come down or something. They're trying to shutting it down. But going forward, concern concept is that we assume that the business will keep running in the future. Okay. Next is accounting period. So the business records are divided into equal time periods for 1 year. They try to record whatever happened for 1 year. So that is called accounting period concept. Okay. Next would be the cost concept. Cost concept is also known as historical cost. Okay, because everything is recorded at the original price. Original price here, not the current market value. Example, you bought a laptop for 1 lakh. Okay, but then we write 1 lakh in the and you try to write 1 lakh in the notes, even if it is worth say 75,000 right now. So everything is recorded at the original price paid, not at the current market value. Next would be the dual aspect or duality concept. Duality here means every transaction has two sides, just like the word. Okay, every transaction has two sides. Something comes in, something will go out. So you buy a chocolate for 10 rupees, chocolate comes in, but money goes out, right? Debit is equal to credit. So that is called as dual concept. Next would be revenue recognition or realization concept. It is also known as realization concept. Okay, so here you record income only when it is actually earned, not when just the money has arrived. Say for example, if you sell a product today but get paid next week, you still record the sale today. You record it now and then and there. Okay, revenue recognition or realization concept means you record the income only when it is actually earned, not just when money is received. So if you sell a product today but but get paid next week, you still record the sale today. That is called as revenue recognition. Next would be matching concept. Matching concept means to match the expenses with the income they help to earn in the same period. Here for example, if you spend 500 to buy and sell sweets but earn 800 in the same month, you record both in that month to find the true profit. So matching concept will help you find the true profit. Okay. So next would be full disclosure concept. Full disclosure concept is showing all important information in the accounts, just like the word disclosure. Full disclosure says like being extremely honest about whatever is happening in the company or in the business. Next is consistency concept. Use the same method every year unless there's a very good reason to change. So you're using this very same method every year. the accounting information given in the financial statement is useful in making conclusions about an enterprise operation. So when it allows comparison across time and within the operations of other firms. So you try to maintain the same concept. Conservatism concept. It is also known as the prudence concept. Okay, prudence. You can see this word. They try to refer what does prudence refer to. It is the conservatism concept. Here, be careful. Always accept losses, but don't assume profits until they actually happen. Here, prudence concept will always prepare you for the worst. Record possible losses early, but wait to record the profits. That is the conservatism concept. So materiality concept. Here you should only record that are very big or very important. Okay, only that matters. If your pencil costs 2 rupees, you don't need to keep a special record. But if you buy a computer, you can actually record it, because right now pencil is not something that you give more importance to, right? So something that has a bigger value. Next is objectivity concept. Use facts and evidence, not feelings or opinions. You should not guess values, or here you should listen to the idea of objectivity. Accounting transaction must be reported rationally, free from the opinion of other people and accountants. So this is just the basic of all the accounting concepts. I hope you understood the session. I'll give you a summary of the basic accounting concepts again. So when it comes to business entity, yeah, I'll take the last slide. So for business entity, here the owner is not equal to the business, okay, which means owner and business are not the same. For money measurement, you only record what has a money value. Going concern, the business will continue to operate for accounting period for 1 year. Financial records for 1 year is recorded. For cost, you should record at the original price. For dual aspect, you have every entry has two sides. For revenue recognition, record income when earned. For matching concept, matching income with related expenses. For full disclosure, you show all important information. For consistency, you use same method every year. For conservatism or prudence, you expect losses, okay, and always don't assume profits. For materiality concept, you try to ignore small things that actually don't matter. For objectivity, you use proofs and not guesses or any kind of emotional decisions. So yes guys, I think we have come to the end of the session. I hope you all enjoyed watching the session. In case if you have any doubts, please let me know in the comment section. And also if you would want me to take a session on any other particular topic, please let me know in the comment section. I would definitely try to make a video on that. And also please like and subscribe to the channel, because it would encourage me to come up with more videos. Thank you.